If you hold XRP right now and you are wondering why your portfolio is bleeding while silver is targeting $120, gold is trading at 6,000 off the official exchanges, and oil just surged 13% in a single session. This video explains every single piece of that puzzle and why the Iran war trade that nobody prepared for is only in its very first chapter. What is up, everyone? I am Bernard, the OG analyst. And this is where we break down the real forces moving precious metals, energy, and the broader macro picture without any agenda, without any hype, and without wasting a single second of your time. Let's get into it. Real quick before we dive in, nothing in this video is financial or investment advice of any kind. This is purely educational content. Gold, silver, oil, crypto, and all financial markets carry significant and real risk. Always do your own research. Always speak to a qualified, licensed financial advisor before making any financial decisions. We are here to analyze the picture and nothing else. Now let's go. Subscribe right now and turn on that notification bell if you want this kind of real-time macro and precious metals analysis delivered to you the moment it drops. You are going to want to be here for what is coming over the next several weeks. Now let me tell you what is actually happening. On Saturday, February 28, 2026, the United States and Israel launched coordinated military strikes on Iran. Those strikes, according to Reuters and multiple corroborating sources, killed Supreme Leader Ali Khamenei. Iran has responded with ballistic missiles directed at Israel. And in the hours that followed, something happened that every serious precious metals investor, every energy trader, and every XRP holder needs to understand at a fundamental level. The Strait of Hormuz, the narrow waterway through which roughly 20% of the world's daily oil supply moves, had oil majors and major trading houses suspended tanker shipments through it. What we are dealing with right now is not a skirmish. This is a direct military confrontation between the United States, Israel, and Iran, and it is actively reshaping the price of every major commodity on the planet in real time. Let me start with oil, because oil is the transmission mechanism that connects everything else in this story. Brent crude jumped 13% on Monday, the first trading day after the strikes, according to DW and CNBC. That was the largest single-day move in oil in 4 years. JP Morgan published a note projecting that Brent crude could hit $120 per barrel if the conflict results in a sustained disruption to Middle Eastern oil supply. Barclays said oil markets might have to face their worst fears on Monday, and that Brent could hit $100 per barrel. Rystad Energy's head of geopolitical analysis estimated that a full Strait of Hormuz disruption would represent an effective loss of 8 to 10 million barrels per day of crude supply in a global market consuming roughly 100 million barrels daily. That is a 10% supply shock to the global oil system, and as of this recording, that disruption is not resolved. It is ongoing, it is live, and the market is only beginning to price what a sustained version of this looks like. Why does oil matter so deeply to the gold and silver story? Because oil is the inflation accelerant that changes the Federal Reserve's entire calculus. When oil spikes this fast and this hard, it does not stay in the gas station price. It moves through every supply chain in the economy: transportation costs, manufacturing inputs, food production, logistics. Everything gets more expensive. And when everything gets more expensive while global growth is already decelerating, remember that fourth quarter GDP came in at just 1.4% recently, you enter the territory of stagflation. Slow growth, rising prices, that is historically the single most powerful macro environment for gold and silver that exists. Not just good, historically extraordinary. And we are walking directly into it right now. Now let me talk about the gold picture, because the $6,000 off-market price that is referenced in our title today deserves a clear and honest explanation. The official COMEX spot price for gold as of Monday's session was trading around $5,300 to $5,400 per ounce, according to finance magnates and Reuters. That is the paper market price, the price quoted on regulated exchanges. But when traditional exchanges were closed over the weekend immediately following the Iran strikes, Reuters specifically reported that tokenized gold products, PXG and Tether Gold, were trading at a premium above that level, with PXG hitting an all-time high of $5,619 per token. And in private over-the-counter transactions, in dealer networks, in the physical gold markets of Dubai and Shanghai and Zurich, the premiums being paid for immediate physical delivery were pushing effective transaction prices toward and beyond the $6,000 level. That is what off-market means in this context. It is not a conspiracy. It is what happens when the paper exchange is closed and physical demand is at emergency levels. Buyers and sellers find each other outside the official system and they pay whatever the physical reality demands. This is one of the most important concepts in precious metals investing that most people never fully understand until they actually need to buy physical metal in a crisis environment. The COMEX spot price and the price you actually pay for a physical ounce of silver or gold in times of acute demand, shock, are not always the same number. Dealers charge premiums above spot. When supply is constrained and demand is surging, those premiums widen dramatically. When exchanges are closed over a weekend during a geopolitical shock of this magnitude, the only price discovery happening is in the private market, and private market prices do not care what Monday's official open says. JP Morgan has a $6,300 year-end target for gold. At the pace this conflict is escalating, that target may prove conservative rather than aggressive. Now let us talk about silver, because silver at $120 is not just a number, it is a statement. Silver briefly touched $121.64 in January 2026, which was its all-time record high according to the Investing News Network. It then pulled back to the low 80s through February volatility. Now, with the Iran strikes triggering the next wave of safe haven demand on top of the supply disruption picture that was already building, silver is climbing back toward that record territory. Analysts at major institutions are now forecasting silver reaching $100 to $150 per ounce in 2026, with the Iran conflict serving as a specific catalyst that accelerates the timeline of that move, according to Intellectia's analysis. And here is what makes silver's current setup genuinely different from a pure geopolitical reaction trade. Gold gets the immediate safe haven bid when war breaks out. Every institutional investor in the world understands gold's role in that moment. Silver gets the safe haven bid too, but silver also carries the weight of a structural supply crisis that has nothing to do with Iran. The silver market is entering its sixth consecutive annual supply deficit. Mexico, the world's largest silver-producing nation at 24 to 28% of global supply, is still navigating a post-cartel decapitation power vacuum following the CIA-assisted killing of El Mencho on February 22nd. COMEX registered silver inventory is covering only 14% of outstanding paper contract obligations, and silver briefly touched $121 in January before pulling back, meaning the market already knows what that price level feels like and has demonstrated a clear willingness to go there again under the right conditions. The right conditions just arrived, in force, all at once. Let me give you the silver supply and demand picture in its complete form right now, because understanding it changes how you interpret every price move in this metal. The Silver Institute projects that 2026 will be the sixth consecutive year of structural supply deficit, meaning the world consumes more silver than it produces before a single mine goes offline, before a single convoy gets blocked, and before a single safe haven buyer adds a single ounce to their portfolio. The deficit closed 2025 at 242 million ounces, according to analyst data cited in a recent Investing.com report. Industrial demand for silver is not slowing down. Solar panel manufacturing, electric vehicle production, semiconductor fabrication, and data center infrastructure all require silver, and all of them are growing simultaneously. The supply side cannot keep pace. And on top of that structural reality, you now have Mexican supply chain disruption from cartel fragmentation, COMEX vault depletion, and a geopolitical war shock driving investment demand, all pressing on the same structurally undersupplied market at the same time. That is not one catalyst. That is 5 independent catalysts stacked on each other. Now, I want to be honest with you about something, because this channel is built on credibility, and I think intellectual honesty matters more than telling you what feels good to hear. Silver is also showing volatility in both directions right now. Economic Times reported this week that silver was actually crashing 7% in one session while gold surged $100, because silver has a dual identity as both a safe haven monetary metal and an industrial metal. When traders fear that a full-scale Middle East war and an oil price spike above $100 per barrel will slow global manufacturing and industrial output, some of them sell silver's industrial demand story even while they buy its safe haven story. That creates the violent two-way price action that Saxo Bank warned about months ago. You can be completely right about the direction of silver over the next 6 to 12 months and still experience painful short-term corrections along the way. That is not a bug in the silver market right now. That is a feature of being in the most structurally interesting precious metals setup in a generation. Let me now bring the oil story back into the full picture because it connects to gold, silver, crypto, and the broader financial environment in ways that are not always discussed together. When JP Morgan projects oil at $120 per barrel in a sustained Middle East conflict scenario, and when Barclays says oil markets may face their worst fears, what they are describing is an inflationary shock to the global economy that the Federal Reserve is not equipped to combat with its current policy toolkit. The Fed cannot print oil. It cannot lower interest rates to bring oil prices down. The only tool it has against inflation is raising interest rates and tightening financial conditions. But doing that in an environment where GDP growth is already at 1.4% and equity markets are already under pressure from war risk creates a policy trap that has no clean exit. Every path the Fed takes from here has significant costs. And in that environment, where fiscal pressure is high, monetary policy is constrained, and inflation is being driven by forces entirely outside the central bank's control, the historical verdict on what hard assets do is very, very clear. Here's the part of this story I want XRP holders to really sit with, because I know many of you have been in a genuinely difficult position for the past 5 months, and you deserve a straight conversation about it. XRP is trading around $1.34 as of this recording. It is down 26% year to date. Standard Chartered has cut its year-end target from $8 to $2.80. That is painful. I am not going to pretend it is not, but here is the analytical truth behind that pain. The macro environment that XRP is navigating right now is one of the most aggressively risk-off environments of the past several years. War in the Middle East, oil spiking 13%, gold at record territory, institutional capital rotating into the oldest and most proven safe haven assets on the planet. In that environment, speculative technology assets, when even fundamentally strong ones, get deprioritized in the short term. This is not a permanent judgment on XRP. This is a temporary but very real rotation dynamic. And here's the thing about XRP specifically that I think gets lost in the war headlines. The Ripple legal situation has moved materially in XRP's favor over the past year. The regulatory environment for crypto in the United States has actually improved. The infrastructure for institutional XRP adoption, RippleNet, the RLUSD stablecoin, and the broader cross-border payments use case is more mature and more credible today than it has ever been. Crypto Bull's analysis suggests XRP could surge to $4 to $9 when macro conditions stabilize and the risk-on appetite returns to crypto markets. Standard Chartered's revised $2.80 target still represents more than 100% upside from current levels. The question for XRP holders right now is not whether the thesis is broken. It is whether you have the patience to hold through a macro storm that is not specifically about XRP and that will eventually pass. Now, let me connect all of these threads into the single most important observation I want to leave you with today, because I think it is the insight that separates the people who navigate this environment well from the people who get shaken out at exactly the wrong moment. What we are watching unfold right now is a convergence event, multiple independent macro forces arriving at the same moment and pointing in the same direction for hard assets. The Iran strikes and the Strait of Hormuz disruption represent a geopolitical shock to the global energy supply that is driving immediate safe haven demand into gold and silver. The oil price spike represents an inflationary force that makes the Federal Reserve's job harder and makes monetary debasement more likely over time, which is structurally bullish for precious metals. The COMEX silver inventory crisis and the Mexican supply chain disruption represent a physical supply shock that was already in place before this week and that has now been amplified by a new demand wave. The tokenized gold market trading at $6,000 off exchange represents institutional and crypto-native buyers pricing gold at levels that the official paper market has not yet formally acknowledged. And XRP sitting at $1.34 represents a deeply discounted asset in a temporarily hostile macro environment, waiting for the rotation back into risk assets that will eventually come when the geopolitical dust settles. My honest analytical view, and please take this as nothing more than one informed person's perspective, is that the precious metals market is in the middle of a repricing event that the mainstream financial media consistently describes as a reaction to a single news headline when in reality it is the culmination of years of structural buildup. Gold did not go from $2,000 to $5,000 in 2 years because of one event. It went there because central banks around the world have been systematically and aggressively buying physical gold while publicly saying nothing about why. It went there because the US fiscal deficit has been running at historically unsustainable levels. It went there because de-dollarization, the global shift away from dollar-denominated reserve assets, has been accelerating since the moment the West froze Russia's reserves in 2022. And now, on top of all of that structural foundation, a kinetic military conflict in the Middle East has added a war premium that has historically been one of the fastest and most powerful accelerants of precious metals prices known to markets. That combination is not a temporary spike. It is a new chapter. Watch gold's behavior around the $5,500 to $5,600 resistance zone this week. That is the area where the previous all-time high was set and where significant technical resistance exists. If gold breaks cleanly above that level and holds, it signals the beginning of the move toward JP Morgan's $6,300 year-end target. Watch silver's ability to hold above the $90 level. That is the line in the sand between a healthy consolidation and a deeper correction. Watch the Strait of Hormuz situation daily. Every headline about de-escalation will put temporary downward pressure on precious metals and temporary upward pressure on risk assets, including crypto. And watch XRP's $1.27 support level as the technical floor that determines whether this becomes a further drawdown or the beginning of a base building phase. Everything is connected right now in ways that require you to look at your entire portfolio, not just one asset in isolation. The person who holds only gold is not seeing the silver supply crisis. The person who holds only silver is not seeing the tokenized gold signal from PAXG. The person who holds only XRP is not seeing how the macro rotation is temporarily working against risk assets. And the person who holds none of these is not seeing how an oil spike, a Middle East war, a Federal Reserve policy trap, and 6 years of silver supply deficit converging simultaneously is building the case for hard assets in a way that has not been seen in this generation. This is not the moment for tunnel vision. This is the moment for the broadest possible view of what is happening and why. Thank you for being here today. If this breakdown gave you a clearer, more complete picture of what is actually driving these markets right now, the oil spike, the gold off-market pricing, the silver supply story, and what it all means for XRP holders sitting in a painful but potentially temporary position, please hit the like button and share this with someone who needs to understand the full picture. Subscribe, turn on that notification bell, and drop a comment below. I want to hear what you are watching most closely this week. Are you holding gold, silver, PAXG, XRP, oil plays, or some combination? Let's talk about it in the comments. I am Bernard, the OG analyst. The market is moving fast right now. It is loud, it is volatile, and it is scary for a lot of people. But the people who came out ahead of every major macro shift in history were not the ones who reacted with fear. They were the ones who understood the setup before it became obvious to everyone else. Stay informed, stay grounded, stay patient. I will see you in the next one.